I always quiz founders when I first meet them, especially when the first time, because that's what people did to me and it helped me learn. I say, like, what's your most important job to do? My answer to them is always, don't let the business die. The longer you stay in the game, you'll have more time to figure it out. Some problems that are unclear on how to solve today might be actually very clear tomorrow. Most founders don't spend enough thinking about actually the VC psychology. In your first round, the biggest thing that they're buying is you. People oftentimes spend way too much time talking about the deepest technical parts of the product, which all of it's going to change in your early days. How many conversations have you had over the last week?
We see 4,000 to 5,000 deals a year. We do maybe 10.
So these are magical things, right? They don't happen. You have to figure out what is the twist that makes them say, oh shoot, this is something we need to do now. Most founders don't think about their process like that. They want to spend more time talking to the VC than they do preparing.
Mitchell's dropping bars now. Mitchell, thank you for joining the pod. I'm super excited to jump right in. I know we're going to talk about the second company you're building, AI, payments, etc. But I want to jump in and talk a little bit about you, how you got started, and then even talk about your first company, Lendtable.
Perfect. Thank you so much for having me, man. Appreciate you as always, and excited to get started. Just for those who don't know me, my name is Mitchell Jones. I'm the founder of Lava. It's my second startup. I've had a pretty fun, exciting career, both in an operator role where, I started my career at Dropbox and Facebook as a product manager. Dropbox doing cybersecurity. Facebook, I was running a digital wallet for Asia and Latin America. And then after that, started my first company, Lendtable. More recently started Lava. Love two things, financial inclusion and payments. So those are the things I love, but just tech broadly. And, it's been great knowing you over the past, how long has it been now?
It's been a long time.
It's been
Pre-pandemic.
Pre-pandemic for sure. So, I'm grateful you wanted to have me on.
Yes. Awesome. Well, let's talk a little bit about that Lendtable experience or just being a first-time founder. You raised $40 million. You scaled a team. Maybe talk a little bit about some mistakes, scar tissue during that journey.
Yeah. And, the first thing I always say is, like, most people think Mitchell's journey started at Lendtable. And that's actually, the iceberg theory applies here. The shooting in the gym with me time was actually way before that. I first got inspired to go into tech. I was, on a desk at Goldman Sachs. I interned there for 2 summers, and I saw these companies, Wealthfront, Betterment, Acorn, Stash popping up, and I'm like, they're, these passively managed robo-advisors are really whooping right now on returns, and it just inspired me because they were like trying to help people where I was from, right? And I thought that was really, really cool. And so then, be me, I didn't know anything about tech at the time. I just start taking notes. And I'm just like having all these ideas. I still have the book, right? I love to go back to that book because it shows me how far I've come. Exactly. And I just was writing down all these ideas when I was on the desk late at night. And then I remember going to Dropbox where, I didn't know anything about tech until really halfway through college at Yale, and then started studying CS, got a job there, was then at Dropbox and Facebook working on ideas in my free time on like trying to how to build my first startup, which, I was going to do a personal financial assistant, which I will tell anybody if you're listening to this and you are building a personal financial assistant, please hit me up. Just message me on LinkedIn. I'd love to talk to you through maybe the things not to do. So I just wanted to really quickly, highlight for everybody most of the journey, right? Like when I was 20 to when I was 25, 26 or 24, those first 4 or 5 years, I was not doing anything in tech, but I was still on the back working on my, if you're using a sports reference, I was working on my form, I was working on my shot, I was working on all these things just so that one day I could do what I was doing then. So you get your moment, but, I wanted to, give props to the Mitchell of, 2020, 2014, 2015, 2016, who didn't know anything and was just trying to figure stuff out. So, but yeah, with Lendtable specifically, tons of lessons to learn, like just for folks that don't know what we do, just what we did very simply is we helped people get their full 401k match if they couldn't afford to get it on your own. So 401ks have this really powerful feature called a match, where if you put up $5,000, your employer can also match you an additional $5,000, for example. Unfortunately, a lot of people can't get that cash. The reason why isn't because they don't understand the value of free money. It's because they're actually very smart. They have student loans. They have kids to feed. They're always going to do those things first. What we would do was we would give you the money you need to get the match. Your match would come in from your employer. Once we validated you have it, we would take our money back and a little bit of what we helped you earn. And, the financial part was pretty impressive. A lot of people were like, wow, I've never seen that model before. But I think the payments part was even more impressive, which was we were the only business really in the world that could get paid out of a 401k like a payment method. And, a lot of that just was, again, building on my chops of that under the iceberg time where I got to learn a lot of great stuff from people like Ginger Baker, who's now the VP of payments at Facebook, who was my manager at Facebook, right? Like you learn a lot of those things in those parts of your experience. So, you got to learn how to assist before you can go shoot and win games. And I think that was one of those things that was really awesome there. But with that background context of Lendtable, the issue that we ran into, or like there were so many things that were really exciting on that journey. First of all, it was a lending retirement company. Lending businesses are very susceptible to macroeconomic shocks. In the 5 years I was running it, we started the business on March 15th, 2020. A week after we started it, the whole world closed down. No one knew what was going to happen to 401ks because unfortunately a lot of people were getting laid off. You fast forward, then you go on this like really awesome, exciting 2021, 2022, where there was a ton of fervor around fintech. So many really great companies were like really taking off in that time. Affirm was coming out really strong out of the really kind of running the wave with Peloton as well, all out of that COVID era. Then you get to 2023 where interest rates go from 0 to 6%. And that's, that's for many lending businesses, that can be a death knell.
Yeah.
And so, over this time, tons of things I saw along the way. But if I really distilled it down, there's probably 3 main takeaways I have for myself. Number one, the most important one is it is easy to be unified when things are great. It is always harder when things are not. And that's when you got to lock in and make sure you are still an excellent leader for your team. Number 2, even if a partnership is not going to materialize until you're a much bigger company, start working the room and knowing those people on day 0. It feels like it's an externality, but it will help your business out in the long run if you do it. And then number 3 is just always, always, always remember, you can just do something different. You can just try a different product. You can just figure something out and look at something a different way. I think a lot of times on that journey, I had moments where I felt locked in on a path and I wish I had understood, oh, wait, I could do some things different here, do some things different there. So, I think those are definitely my takeaways from my big 3 from Lendtable, and I could go into any of those 3.
Yeah, I mean, I think that those are really amazing. And one thing that we talk about at Harlem Capital is folks, the person who's keeping a founder or management team from pivoting is usually the founder or the management team. Investors or other people who might even be just working under the management team can see that some things might not be working. And they want to work on something different. They want to be something a little bit more creative and adjacent. And sometimes because founders or management teams, like this is their baby, sometimes you have that hard opportunity to just like look yourself in the mirror and be like, we should evolve the idea. We should evolve the business. We should be more creative. And that goes into my second point. So second time founder, we're excited.
Yeah.
We learn so much. We have all these 3 things in our back pocket. I want to ask you, what are the pros and the cons of being a second time founder? From my perspective, the pro is like, all the hard things. You know how to hire processes. You know how to do all the back office different things. And that's really cool. The cons could be too much. You've been too close. Yeah. You don't want to make this mistake. And because you don't want to make this mistake, you might not take the same risk. Yeah. So I'm curious of how you've been seeing the positives on being a second time founder, and what are potentially some of the things you want to try to avoid. Last point, second time founders love to scale teams faster. Yeah. They love to hire their entire group of people. And so what are you doing to have like checks and balances, if you will?
So for pros, I think there's 2 main pros. The first one, the orders of magnitude more important than the second. The first pro is that you can stare the edge of the cliff in the face and you don't get scared anymore. Right? Things scare you all the time, but there's certain things where bad stuff has happened to you before. It happens all the time.
I've started a company before, and these things have happened.
They've happened, right? And what your first company, your first venture it teaches you to accept that bad things are going to happen on the journey. That is a part of it. That is a part of why not many people can sit in a seat, right? Every week there's another problem of the century happening. And it makes sense. Like if you zoom out and think about it, you're building something from scratch. Everything doesn't work, right? Like when you think about most businesses, they have thousands of people trying to make sure very small things work well. When it's just you, every single thing breaks. Every customer is a larger percentage of your revenue. Every failure that happens, it's all going to be pushed back on you. And so that's a tough seat to sit in for the first time. I think the second one is you get a lot of credit for the fact that you just did it. Whether or not you made $1 billion doing it, people respect the fact that you went through it, you went through the pain of doing the process, and you even want to do it again. And because of that, there's like a credit that folks will give you, both your employees, your investors, the outside world. They will give you that for doing that. And I think that's actually super valuable and super helpful. But definitely the first one, right? Nothing feels as big or as scary. The way I always kind of explain it to people is imagine you played a video game and you got halfway through the game, right? And imagine the first time you played it. And it could be a really difficult game. Make it Elden Ring, where it's just like you're getting whooped the whole first 50 hours you play or whatever. And what you actually learn, though, is once you've done it once, actually the way you beat the first boss is if you stand in the corner and use your long range stuff, you're going to be able to get by that boss actually super easy. But you banged your head against a wall for 50 hours the first time you did it. Well, that's what it's kind of like when you're doing a second time startup. You've done a lot of the issues, right? Oh, the way I get by this boss, I just, creep over there into the corner and do that. And so that's where a lot of that comes from. I think on cons, I think the biggest con is I think you nailed it. It's a lot and enough to be dangerous. And when you know enough to be dangerous, a lot of times you're sometimes trying to future-proof a bit too much. And you have to remind yourself that the way you actually build startups is you kind of have an idea and a roadmap in mind. You go and you're very narrow on executing it, but you also take what the defense gives you. Things change all the time. And if you're not fluid and ready for those changes, your grand strategy is going to change, right? And if you think because you knew the grand strategy of business one, the grand strategy of business two, that's actually a hubris. You can't, it's just, they're completely different. So I'd say the biggest con is actually the biggest strength, which is the confidence you get from saying I've stared at bad things in the face. It can lead you to think, oh, I've actually dealt with this before. And foundationally, the problem might be actually slightly different, right? Lending and payments are two different businesses, right? Retirement is a very different regulation space than money movement, right? And so how you approach those problems, you always have to have the humility to say no, I'm learning a lot of things from square one again.
Well, that brings me to the next point. How did we come up with Lava, the future of AI payments? You've had a very deep thesis on this.
Yeah.
We had a day where you came by my place, we co-worked, and for 2 to 3 hours, you ran me through what you're working on for today and how you got to it, but also you took me to the future.
Yeah.
Hey, here's 5, 10 years from now
Yeah.
where agents are doing all the payments and where people are paying for usage versus some type of subscription. So curious how you even stumbled upon the idea of going into AI payments, and then what the future of that's going to look like.
Yeah. So I stumbled into this the same way I think every founder stumbles into a problem that they end up wanting to do for 5 to 10 years, maybe even longer if you're lucky. I was just genuinely interested in the space. I love payment stuff, right? It's a lot of my career has been doing that. And when I was just playing around building stuff, I recognized some observations oh shoot, this might actually be a bigger issue than I thought. And then I just talked to potential customers, and I just talked to people, right? Help me understand, what am I seeing wrong? So if we really zoom out, I think the first big aha moment I had was that foundationally, it started with a very, very simple observation on pricing, and that was broken. And, when I look at AI, it's a utility. Every single utility you can think of how does it price? Your water prices on a
Meter.
your electricity prices on a
Meter.
in almost every country in the world other than the United States where we buy the unlimited meter plan for your data on your phone, it prices on a
Meter, yeah.
And so when you build a utility, usually there's some measurement incorporated in it. The first thing that made no sense to me was why was there none of that associated with all this compute usage? So then I went and talked to a couple friends I knew in YC. I was a former YC founder for Lendtable. And, they told me, Mitch, the issue's even bigger than that. Like, you're so right that there's like a mismatch in terms of like the payments and also how the business is going to make money. A lot of times they were like, there's a couple issues. Number one, investors aren't hip to it yet. They really like the idea of like seat-based pricing. And, it's consistent, it's understandable. The math makes sense.
Easy to underwrite.
Really easy. And founders, just so you know, when you pitch things, the simpler the better in your pitch. Never forget that. And that's why it's like for things like that. But they said that there's actually a bigger issue at play. They were like, Mitch, I'm building an agent. And if I build a really good agent, I'm going to make less money. And I'm like, what do you mean? Like, you build a good product, you make more money. And they're like, no, think about it. Like, if I build a really, really good agent, there's a need for fewer seats. The fewer need for seats means that, and then also with my compute costs scaling up, I'm going to actually potentially have situations where I can get a negative margin. And I'm like, oh, damn, that's a problem. And so the next question I had was like, well, why don't you incorporate pricing that uses measurement, right? Like, if seats are not working, then like you're going to need to show your work, show the work you've done, get paid for it. That's how every utility company in the world has ever done it. And folks were like, yeah, that's a huge issue, but I don't have a really easy system to hook all this stuff up.
Right.
And
You're hacking it together at that point.
Exactly. My time is so valuable. And that was when I was like, ding, 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 ding. Startup founders recognize that $1 trillion is going to be moving from SaaS seat pricing to measurement-based pricing. There's also going to be new types of companies that weren't SaaS companies, so think services, right? I think YC, one of their pitches was, don't go make software for law firms, go make the law firm, right? Well, that's going to end up having its own pricing model that's not going to look like probably a SaaS seat-based model. And so there's this big flow of revenues that are going to go to a different style of pricing. And there's no real solution or really strong infrastructure that's looked at this from the framework of AI specifically in order to implement it. And that was a very, very big problem, right? And so that was really what got me started. The second bit was that I had an insight on how I thought this is going to look in 10 years, which was, I don't think that a human is going to be in the loop for most of these transactions. And most of the time, what that means is the AI agents or workflows that, my customers are building, they don't go just one way. It's not just collecting money from you. Their agent is collecting money from the customer, but then they're going and paying for things over here in order to fulfill a service for the customer as well.
Right.
Well, there's only one type of infrastructure that can both bring money in and send money out, and that's called a wallet, which that's why it's a little bit bigger than just a billing problem. You have to really look at this from a very holistic perspective. And for us, the fact was, stage one, we got to figure out how to move all this money. And we have to make sure the pricing models actually match, which means measurement-based pricing is the future. But stage two is, how do you empower your agent so that the same place where you're getting paid for the work it's doing is the same place it can use to go pay for things it's doing for customers as well.
Wow. That is super awesome. And maybe did you want to also talk about the two products that you're working with on Founders right now?
Yeah. So if we really take a step back, like, what is Lava at a high level? What are we doing for you today? Lava makes it super easy for any company, especially AI companies, to track all of their LLM usage by customer, pricing plan, and charge for that. What we do really, really well, and we do, in my opinion, best in class, is we make it easy so that you're not doing all of the work on sending your payments orchestration a bunch of different signals that you have to then use to incorporate into pricing. It's too much work for founders. So we have two products that help us do this. We have Lava Build, which is our AI gateway, and Lava Monetize, which is our payments orchestration product. Those two things work together in order to make it super easy for you to track all of your usage, right? You use one API, you route to all of your customers, so you don't have to integrate into every single LLM. You can just use the Lava API and call every LLM from there. And because we saw that going in when you were building, we can just ask you, hey, that cost you $100 of model costs in order to serve that product. How much do you want to make on it? Do you want to make a 50% margin, 100% margin? You tell me. Whereas every other tool, you have to send them what could be hundreds or thousands of post requests, which is just a way to send data and information to the orchestrator. You're going to have to send a bunch of those over and tell them how to understand their data. That can be days or weeks of work. And we've now been able to compress that down into hours. And that's really the powerful thing we do there.
That's awesome. I want to transition a little bit to fundraising.
Yep.
You are a prolific fundraiser, and you have many Mitchell-isms. That's what I call them, where there's like one or two lines of like, how do you fundraise?
Yeah.
One of them recently is like, the best time to fundraise is when you're not fundraising.
Yep.
So you nurture folks who are going to potentially be investors in the future. You have an amazing newsletter that you send out to prospective investors, people who haven't even invested in a business yet. And there's so many other things that you do to really build up trust, I would call, with the people who could really help scale your company. So maybe talk a little bit about your thesis and theology around fundraising, or even you gave me 3 things to win. I believe it was experience, it was maybe execution, and then it was money, I believe. So feel free to like go deep into that space.
Well, first of all, I learned fundraising from a lot of people who were much better fundraisers than me. And like one of the things that was like great, it was that like, tech is just a very pay it forward culture. And the more you come at it from a humble angle of like, you're just trying to learn how to get better every single day, you usually will get better every single day. I think fundraising is one of the most counterintuitive exercises you will ever do. And the first piece of advice I would say for fundraising is if you really are ever in a pinch and you don't really know what you should do in a situation, the biggest piece of advice I'd say is to be a good test taker. Think like the test maker. The test maker is the VC. There's a lot of things a VC needs to do or understand in order to write a check. And most founders don't spend enough thinking about actually the VC psychology, right? Which is super important. And when you understand how they operate, you will inherently become a better founder, right? VC is a very strong link game. One pick can foundationally change an investor's life, right? One pick can do that. And so what that means, though, is the average pick is not. And so you really have to understand that when it comes to like their time, what they're looking for, what signals they need. For example, one thing a mistake a lot of early founders will make. Often they will spend a lot of time trying to convince a VC who just like really doesn't believe in what they're doing. And it's a mistake a lot of founders make because your best asset is time.
Yeah.
And, one little thing that was always told to me is, VC trumps founder, traction trumps VC. If the VC just is not believing in that space or that thing, the way you're going to change their mind is you're going to have traction later. Your job in the earliest of stages is not to convince somebody why you're not flawed. Your company is flawed. If it wasn't flawed, you'd be a unicorn already. The real thing your job is to do is to try to sift through conversations as quickly as you can to find the person who's been looking for you in spite of all your flaws. They like dusted you off out the trash and you're like, this is the diamond I've been looking for. That is what you're spending your time looking for. Most folks don't look at it that way. So they spend time trying to send all this proof and extra stuff and data and information, and you're taking time away from the core thing. What you need to do is get more traction.
Yeah.
Right. And so that is a lot of those mistakes. So, one of the things is we're very, very sensitive with our time. Like we don't really, most of my time if I'm not in fundraising mode, I'm working with the team. Like we got stuff to do. So I'd say that's definitely one of the big ones that I think is a common mistake folks make is number one is you got to think like the test maker. And I think a lot of people don't necessarily always see that. And then number two is your job isn't to convince that person why you're not flawed. you are flawed. Like you're
Big
truly
time
flawed.
flawed.
Lava is flawed. Lendtable was flawed. Parable, the idea I was working on for that is flawed. Like every early stage company has tons of flaws. A great VC can stomach that because again, think about the test maker. The test maker is investing in your potential, right? They're investing in what you're going to become. And so they have to really believe in that space or believe in that thing, which leads to probably the second thing is you got to understand the forces that compel investors to invest, right?
What are those forces? Yeah.
Number one is, and I think it gets back to a little bit of what I kind of told you before is like, I think most investors are looking for some combination of, first and foremost, is your market has to be big enough for it to even make sense for them, right? And this gets back into the dynamics of understanding what a VC needs to do to return their fund or to have a very impactful outcome, right? If your market is $500 million and it's not growing fast, right? That doesn't work. If you're in a small pond and it's growing really fast and it's become a mega billion-dollar pond in like the next 5 years, great. But if it's not, then that's a problem.
Because most VCs want to invest in a company that can at least have like $1 billion
exactly
of revenue, and if your market size is 500 million,
right? Okay, you might have to, no matter how great of a product you'll make, the test maker is going to keep failing you on question one. They're like, man, I like the product, but I can't return you need to be the 1 in 1,000, the 1 in 100. That's not going to do it. That's not going to make it work. And so that's like an example of one of the forces is the market. Number two is obviously at the end of the day, you have to show experience, right? And it doesn't mean you have to have done it before, but you have to show that you are someone that they can put their money in and they can trust, right? And I think a lot of founders underestimate that at the beginning, right? In your first round, the biggest thing that they're buying is you. It's you. People oftentimes spend way too much time talking about like the deepest technical parts of the product, which all of it's going to change in your early days.
and it may not even be post-product
right
yet.
thing,
It may
right?
not even be live yet.
Exactly. So what they're betting on, the biggest thing that they're underwriting at the beginning is you. So the market, you as a person is obviously the biggest second force. And the final one is the twist. What is the thing that makes someone say, now is the time? If there's no element of fear of missing out on something, it's probably not going to get done. Deals are a magical thing. They almost never happen. When you really zoom out, think about how many conversations have you had over the last week?
We see 4,000 to 5,000 deals a year. We do maybe 10.
So they never have. These are magical things, right? They don't happen. And so when you start to think they're literally unicorns in themselves. So when you think about it through that angle, you have to figure out what is the twist that makes them say, "Oh shoot, this isn't the 1 in 5,000. I've heard this all the time. No, this is something we need to do now." And most founders, every business is different, right? And every space is different. But you have to obsess over finding that because that is what gets them interested, right? In some spaces, we have done a technical unlock that no one else is going to be able to capture for the next 5 years. And because we did that, we have time to just get so much market share, but the moment is now. We got a 5-year clock before someone else can do it. For others, it's like, hey, I just finished a company and I'm a once in a decade person. And I know that this new thing is going to be a space. I'm obviously going to be the one to win it. Are you in or are you not? Others, it's, hey, we just saw blank company get acquired and that's now made it so there's a huge gap in this market and someone's got to fill it, right? There's a bunch of different things there, but those are the things that really are that twist, right? There's these kind of check the box things you have to have. The market's got to be big. You as a founder have to be that person. But the real thing that gets that 1 in 5,000, 4,000 done is no, the time is now. And here's why that time is now.
I love that. Your Mitchell-isms and philosophy on fundraising has always been like very, very interesting to me. And I think even from our perspective, there was someone who was a mentor to us at Harlem Capital. He said, you don't convince people when you're fundraising. You want to start talking to people who already believe in what you believe in.
Yep.
And if you can pitch people who already believe what you believe in, you could win the battle by just proving to them through some of the things that you mentioned that you are the best person in that category of what they believe in. And if you do that, then you can start to unlock so many different things.
100%. I think I call this actually, I don't call it this. It's from a book called Never Split the Difference. It's called an
Great
accusation audit.
negotiation.
It's an accusation audit. One of the best things you can do is simplify the noise through the chaos. You're talking to an investor, and they're again, psychology. Is this the 1 in 5,000? At the end of the day, though, you always got to bring it back and say, accusation audit. Here's what I believe. You've said you believe these things too. If we both believe these things, you need to make a bet on somebody. Is it going to be me? Is it going to be someone else? That's okay. And that flipping of the script is actually super powerful because it actually helps you help the test maker do what they need to do. It's like, oh, you're right. I do want to make a bet on this space. I do believe in it. And also it's refreshing to say, if you don't believe these things, all good, right? Like if you don't, that's okay. Actually, let's know this now because my time could be spent trying to find someone who does believe that. And that is something that founders, the more you actually start to incorporate that into your pitch is like, look, here's who we're for. If you believe these things, great. If you don't believe these things, probably not. Like, for example, for Lava, if you believe that measurement-based pricing does not make sense, and you truly believe that it's like fixed pricing, although, compute costs are going to only, like increase, right? Like, or the amount of compute consumed unit costs will go down, but total number of compute will continue to increase. If you don't believe that, and if you believe subscriptions are going to be perfectly fine, and then great, all good.
Shouldn't be talking.
The legacy tools, they got this on lock. They're ready to go, right? If you don't believe that, and you do believe that $1 trillion needs to move that way, we should be talking, right? And whether it's not, and if it's not me, all good. You should find somebody though in that space who is interesting to you, and then that is really a super important thing. And founders oftentimes never get to that level because they're selling too much, right? They're trying to sell why you should believe in it as opposed to like, here's what we do, here's what we're executing on, here's why I'm the person. Are you in? Are you not?
Yeah, it's really interesting because founders basically, they have to convert talent all the time to build their team. They have to convert customers all the time to grow revenue. But with an investor relationship, I've been calling it just trust.
Yeah.
Our number one focus is building trust with each other. And I've been saying this now, trust comes before the transaction, right? Most investors, if I'm an investor and I'm going to do 2 to 3 deals a year, of those 2 to 3, a majority of those are people I already know. So people I've built trust with, people I believe the same thing with. And if we have the same vision and I have trust and you're showing me insider information, I'm sharing you some of my network, we can now trust that we can go further together.
Yeah.
And it's a no-brainer. It's an obvious yes after that.
You're completely right. So a lot of times, and I try to explain this to founders too, of like most of the work in fundraising actually goes when you're not in the room at all. The analogy I give them is, how long is a football game? I'm asking you.
60 minutes?
It's like,
supposed
a little bit more. 60 minutes with all the stoppage time and all that stuff. So it's a little bit more, but 60 minutes, right? How much time does a coach spend watching film before a game?
Hours.
How much time do you spend practicing for a game?
Hours. Days.
Right? Days, right? How much time do you spend making sure you're in rehab so that you're getting all your injuries ready for the next game?
Hours.
Right? So when you add all that up, you have 60 minutes, but you actually prepared days for 60 minutes. Most founders don't think about their process like that. They want to spend more time talking to the VC than they do preparing. And then you might ask me, well, what are you preparing? Well, first of all, again, back to the thesis of your time, are there some VCs it does not even make sense to talk to right now? Right? Questions that most founders don't think to ask. Where's the VC in their fund cycle? Right? Are they like gathering information right now? Are they actually actively deploying right now? What stage do they play at? Have they made a competing bet? Right? Like all of these things will help you slim down. Who is the right person at a fund to talk to? Right? And then how do I make sure I've talked to that person before I was even raising money so that I can be on their radar? Again, 1 in 5,000. No one wants to bet on somebody they've never heard of before with 1 in 5,000. You want to know that person.
Yeah, and you got to take 2 weeks to have a 10-year marriage.
Exactly, right?
Why would I? Yeah, and it's both ways. Like if you're a founder and you're about to fundraise and let's say you need to talk to like 60 to 70 investors to get 2 or 3 to give you a term sheet, if you don't know a majority of those
Nope.
people, it's not gonna go that well. If you've never got in
Absolutely.
front of them before, you can't get a warm intro. You've never written anything on
Yep.
LinkedIn, and so I do think that founders really need to understand you have to do your research,
Yep.
like super deep research. You have to leverage your network. There is like signaling in humans connecting and doing these things, and then lastly, like you also just have to be one of the smartest or unique visions in that industry.
Correct.
Those three things are what investors look for, and we will fight literally to the death because one of those can like make our career.
Yep.
So I have two last points I want to hit.
Let's do it.
The first one is just I'm trying to understand how you're thinking about like the future of AI in general, right? We're super early. We
Yeah.
literally just have a few foundation labs. There technically outside of NVIDIA, there are no publicly traded AI companies. Right? So
Yeah.
we're super early. So I'm curious, just like how are you thinking about some of the things that are going on in AI, whether it be AGI versus applications, or even we were talking before this about the one person billion-dollar company.
Yeah.
Where do you see the future of AI, and like what are you building to?
Yeah. So, well, first of all, I'll say it's like there are brilliant people at the foundational model companies, so they know a ton of stuff that I don't know. I think for me, I'll take the first one first on AGI versus applications. Um, I actually, I'm not. There are people who know a lot more about this than me, but I'm not sure if through LLMs alone, you can actually hit AGI. It's just a very, or what the public thinks of as AGI, which is this like idea of like a Jarvis who's just as like sentient as you and me, right? Like LLMs are just really just a prediction pattern on language, and you can learn a ton about how humans AGI think through language, but it's not all just language. And so there's probably going to be some other combinations of other types of models and things like that. So, for me, I think that the real boon is actually in applications. When you look at how many things have not happened yet, and that could be orders of magnitude more. Imagine when models are small enough and efficient enough
To
to be
run
on
on
your phone,
phones, yeah.
right? Like
I
that
knew
has
you were
not
going there.
that has not happened yet, right? Imagine when instead of having very fixed apps, right? I have to have an app for this. I have to have an app for this. I have to have an app for this. A model can just in real time formulate around the exact thing you need to do, right? As opposed to having these like home screen with like a trillion different things on it. You have one thing and it really forms into the thing you need to do in that moment, right? There's all of these different apps. Imagine when, Claude Code can run for 5 hours on its own as opposed to, 5 minutes on its own, right? Like imagine as those things get more and more and more, that's all application stuff. That opens up a plethora of new things. And again, AI is the utility. Now all the things are going to be built on top of the utility, and that's where it's going to get exciting. So, I think AGI is long term probably not necessarily the right kind of path to run up. I think that it's great from a more maybe marketing perspective of like it pushes the field forward on what models can do. But I think the applications is going to be where all of the value ends up coming out of it long run. And I mean, you're kind of saying it, but this is a very interesting time we're in right now when it comes to this, like with Apple's recent choice of Gemini, with, a lot of the things we're seeing in terms of like which directions Claude is heading in or Anthropic is heading in versus OpenAI, et cetera, with, all of those new trends. There's just a lot of interesting things happening. But I think the big thing is there's brilliant people at those companies who are going to figure it out. You said another thing, which was around, this idea of
Oh,
the
the
one person.
$1 billion.
I actually think so. This one is probably a little bit counter to what everyone likes to think. The one person company is actually synonymous with the 0 person company,
Oh, it just runs autonomous.
and the reason why,
I
if
mean,
you
basically it
can,
does because the human just presses.
if you can truly get to a 1 person company, the limiting factor is actually the human. And so one of the things that you cannot fix with AI is we are bounded by time. And so Dunbar's law applies to us. Dunbar's law is you can only have so many meaningful interactions in a day. So imagine you are the scale of a $1 billion company. the amount of decisions that you need to understand and make well in the course of not even 24 hours, which is, let's just say you're dialed in and you're working 16-hour days. You're not probably going to be able to make all of those deep decisions in that amount of time, right? Or maybe you can, but I don't think most people can. So then what that ends up meaning is you are the limiting factor actually on that. So once you get to the point where there's a one-person company, you're effectively at the point where there's a zero-person company because you're the bottleneck, which means that AI has gotten to such a good point at discretion and understanding, it can actually make really good judgment. Where, anybody coding with LLMs today, you still see like so many things with judgment that just are not there yet.
Wow.
So I think the one person company thing it's very exciting to think about, but I think it's more synonymous with the 0-person company, which is where AI can just say, go make $1 billion company and go do it. Because once you can get to one, that's the delta is, in my opinion, it's not high.
It's like the Roger Bannister.
Correct.
We do the 4-minute mile within 7 days. 10 people did the 4-minute mile.
Correct. Right. And so the big limiter is actually Dunbar's law, which is we actually become the bottleneck if you can truly get that low because of how many decisions we can make. You can spin up 1 trillion instances of a model, right? And they can run all in parallel. You can container them. You can do all that stuff. But with you, at least at this point in the game, you can't really split your own consciousness in order to do all those things.
I have a hot take on this. Basically, with the 1-person $1 billion company, and then also AGI. Have you ever heard of the great man theory?
No.
A great man theory is just this theory that every generation there's this great man who pushes us into the next kind of echelon of technology, whether it's steam engine, combustion engine, whether it's the Model T, whether it was Rockefeller with industrializing factories so that people can work in factories and oil can be used in everything. So from my opinion, it's more of like Sam Altman and Elon Musk are part of that great man theory. You need people who are going to will something to existence. And we're getting to the point where we just can't have people will into existence. You have to have another entity that is not human, almost like religion, which is like AGI. Because I was reading that the person who originally came up with artificial intelligence, the professor, he was looking for more funding. So he just made up the name artificial intelligence to get more funding for his PhD work. So he was a great man. He was a great man that came up with the idea. And so I assume...
Sounds like he's a great fundraiser.
Yeah, whether it's Sam Altman or someone else pushing AGI, and it'll be new. Like the same thing happened in crypto, right? We went from Bitcoin to all this stuff in crypto, Web 2, then we turned into Web 3. Web 2 was lit. Not anymore. So the next crypto will have to say something that's different than Web 3. So I think that AGI, the 1-person $1 billion company, these are just great man theories that happen to not be men that push us forward.
Let me ask you a question. Do you think that originality is an important part in the great man? So
independent thinking.
Correct. So so this idea that like an original thought was those great men had like an original thought that pushed it forward, or do you think it was more iterative?
It was iterative, but the other piece is like this person, like Andrew Carnegie is like one of the poster childs for a great man theory, because you have to be an industrialist. Like you literally have to change the world so much that you open up entire markets and then you participate greatly in those markets. And that's what a kind of like a great man was. And obviously back in the days before that, these were like kings, queens, kingdoms. But now you literally have companies that, if you look at the Mag 7 or even just like top 20 companies, these companies make more money than the GDP of many other countries. So you have nation states that are companies. And guess what's coming up? Those people who run those companies are creating narratives and becoming great men and women. And the best narrative to ever create is one that you can't change, which is like an AGI or whatever. Or even Warren Buffett says like the best part about like Geico insurance is that the actual Geico is not real. You don't have to pay anybody. It's just a theory that you just put a Geico in front of everyone loves it. It's super awesome. But I think this is a great place to probably end. We appreciate you coming on to the pod, and we'll have you back.
course, thank you so much. And then just for anybody out there, if you're a founder and you're trying to figure out how to make your AI pricing work and you're like, oh my goodness, how do I make subscriptions work with usage and overage and all of these things? Don't run up a wall for days and weeks. Come to lava.so. We will help you out. Or just literally just add me on LinkedIn. Say, hey, Mitch, I need to get set up, and we'll get you hooked up in hours. Thank you.
Thank you.
All right.